Okay, so fair value. You might have thought we only dealt with assets with this, but actually you have the option, or a company has an option, to record not only its assets but also its liabilities at fair value. And it doesn't have to record all of its liabilities at fair value. It can pick and choose, as it says, on an instrument by instrument basis. So they can mix and match. This to me says you've got apples and oranges on your balance statement, but on your balance sheet, but I don't make the rules. So the idea is that a company can pick and choose which assets and which liabilities it wants to report at fair value. So the only good thing here, I guess, is a company has to make the election when an item originates, not allowed to switch methods once a method is chosen. So let me give you a number example on how this would work. All right. So on July 1st, HSA issued a $200,000 face value 8%, priced at $180,000 to yield an effective rate of 10%. All right. So we're not going to get into the math on this. We're just going to take their numbers and go with it. But it's important to realize you are dealing with a discount here, right? Because the effective rate is 10%, but our bonds are only paying at 8%. So here we go. Here's the original journal entry, debit to interest, or not the original journal entry, I'm sorry. This is the first journal entry for interest. So you've got a debit to interest expense, $180, $9,000 for $180 at 5%, which is $9,000. Discount of bonds payable, $1,000, cash $8,000. Okay, so this is different numbers, but same process as what our last what I did in the last screencast. All right. So what this looks like right now is you've got bonds payable of $200,000. That's how much the face value of the bonds are, the $200,000 right here. And you've got a discount. You had a discount initially of, I suppose, of $20,000, right? And now the discount is $19,000 because you brought it down by $1,000. All right. So you've got 200. So the book value of these bonds, $181,000. Oh, hang on. Now let's get into the fair value part of this. So we decided on December 31st, we figured out that the fair value of the bonds was $183,000, but we're carrying them at $181,000. So that means there is a $2,000 adjustment for fair value needed. All right. So we don't touch the bonds payable account, but what we do realize is we are carrying it right now. Okay, I got interrupted by a cell phone call, dogs barking, and a doorbell. So let's see, where did I leave off? Looking at this, what you have here is you've got the value of the account in your books is $181,000, but this thing, its fair value is $183,000. So what you've got is you've got a loss. You've got an unrealized holding loss because you remember you're dealing with a liability here. But you're not going to actually touch the bonds payable account. You're going to have this valuation, or as it says, or contra account. So here you got the fair value adjustment. You've got a credit of $2,000 that'll bring the fair value of the bonds up to the $183,000 since you're dealing with a liability here. All right, and you're going to have to adjust that every period, and you'll have an unrealized holding loss in the income statement. All right. All right, so let's move this on to long-term notes, which actually are not a whole heck of a lot different than long-term bonds. Installment notes are, but regular long-term notes are very similar to bonds as far as journal entries and calculations go. So here's an example. We've got Skill Graphics. They really like these numbers. $700,000, 3 years, $42,000 with interest. You have the same journal entry, right? Cash, notes payable instead of bonds payable, and you've got notes receivable instead of investment and cash on the lender side. All right. Moving forward. At the end of each of the 6 interest dates, you're paying interest, or the borrower, the company's paying interest, and the investor is getting interest revenue and cash. And at the maturity, you pay off the $700,000, and here they've received their $700,000 back. All right, so it's the same as bonds in that it's interest, 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 interest until you finally pay out the full amount of the principal, versus an installment note, which is going to be a little bit different. An installment note is going to be some principal and some interest along with every payment. So you're not paying out all of the principal at the end. All right, so instead of interest, 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 principal, instead it's going to be interest and principal, interest and principal, interest and principal, right? So the idea, this is similar to the loans you would be used to. This would be a car loan. This would be not a lease, but this would be a car loan. This would be a mortgage. This would be any of those things. All right, and we're for this we're dealing with installment notes. All right, so how do we calculate interest on each one of these? It's going to be the effective interest times the outstanding balance of the debt. And that's really the key here, is the fact that this number is going to keep changing, because every time you pay off some of the debt, the amount that you're calculating the interest on goes down. And anybody who has a mortgage knows this, because as the principal balance goes down, the amount of interest that you're paying also goes down. All right, so let's look at it, that installment loan for the same amounts we've been working with, that same $700,000, but we're looking at the present value here, divided by the present value of the annuity, gives you the actual installment payment. Let me show you how that's calculated, because we haven't really talked division at all. So let me move over to Excel and get rid of what we're dealing with here. If you think about it, the present value of the annuity is equal to the payment amount times the present value of the annuity factor. All right, so what we do know, the present value of the annuity, is $666,633. I think that's the right number. What we don't know is we don't know the payment amount. And we also know the present value of the annuity factor if we went to that table using that that I being 7% and N being 6, the same as we've been using before. It is 4.76654. So all this equation is doing is really taking that 636,666, too many number sixes here, 633, divided by that 76654, and that's going to give you the 139,857, which is the payment. Okay, so what we're doing is taking the 666 divided by the 4.7, and it's going to give me the payment amount. So that's the reason I know you haven't seen it as division before, at least in any of my lectures. So I just want to show you why it is dividing it here to come up with the installment payment. So here's the amount of the payment. This is, again, like your mortgage, right? This is your standard monthly payment, but the interest is going to change, and the interest is going to go down every period, right? So it's going to be the 0.07 times 7% times the outstanding balance, gives you the 46,664. Well, that's the piece that's interest of this payment, and that's the piece that's a decrease in debt. So you would take the outstanding balance, 666 minus the 93,000 would give you, now the new balance is 573. So you're going to take 573 times 7% is going to give you 40,141. Well, that's now your interest. So the payment doesn't change, but now that's the piece that's interest, and then the rest of it is principal. So now you take the 573 minus the 99,000, and your outstanding balance is 473. So that's what you're going to calculate interest on. So that's really the key piece, and that's what I said before, is to realize that this is going to keep changing, because as you reduce the principal amount, you're going to need to calculate interest again, and that's, in my opinion, the trickiest part of an installment note. All right, and like I said, this is how your mortgage is calculated. So if you've never run an amortization table, which is what this basically is, on a mortgage, on your own mortgage, then do it online. And a lot of times when you do it online, it just shows you the amounts, but a lot of times they give you the option of downloading the table. Download the table and you'll see that this is exactly what it's doing. Okay, what if you pay off debt early as a company? Well, if you retire the debt at maturity, you're fine. No gains and losses. It is how it's been. Nothing changes. But let's say you do it early. You're going to have a gain or a loss you might have a gain or a loss on the extinguishment of the debt. So cash proceeds minus the book value gives you the gain or loss. And let's look at a calculation here. So here we go. We've got Masterware again. You've got their $700,000. At least they're being consistent. And it is nice that they're consistent, because it's easier to kind of follow through these examples if you're dealing with the same numbers. But you've got 12% bonds. Their carrying value, right? That means their book value right now is $676,290. We specify a call price of the indenture of $685,000. All right. So what we've got here is we've got a difference of $87.10, I guess, right? So what you're doing is you're going to debit the bonds payable for $700,000. You're going to get rid of the discount through right now. You're going to pay off the cash amount, the $685,000, and the difference between what you were carrying this thing for and what you're paying it off, the $676 and the $685, is going to be a loss to you on the early extinguishment of debt, and that's fine. It's no issue at all to do. It's just a matter of that, you may want to pay this off early. You might have a money that's laying around, and you might want to make your ratios for your debt ratios look better to future investors. So it's something that a company may want to do. All right, I'm going to try to wrap this up since there aren't really any more calculations that are challenging, in my opinion, too much in this chapter. So I'm just going to hit on a couple of topics. There are convertible bonds, another type of bonds. You can convert these. The bondholder can convert them into stock. So if they decide that the bonds aren't paying out well, but the stock is paying out really well, they may decide they want to convert them and maybe sell the stock instead. All right. When they do get converted, the company has to, take the bonds off the books and, get rid of any discount along the way. And the shares of common stock that are converted to are increased. Sometimes companies try to induce conversion, right? They're trying to basically say, hey, this is a really good thing. You should convert to stock. And, they want to fix their ratios. They want to get, as it says, you want to achieve a lower debt to equity ratio. They don't want as much long-term debt on their books. So they may try to convince people to convert. They may offer them incentives to convert. They may say, we'll give you something extra if you convert. So there's a lot of incentive here, but it is a possibility to convert these things into stock. Detachable warrants. So it's almost like the bond is sold with, in my head, I see them as coupons attached to it. I don't really know how it actually looks, but the idea is you've got a bond with detachable warrants. You can sell, it's almost like you get two securities in one when you make the purchase, because you can turn around and sell these warrants, and these warrants have the option to purchase numbers of shares of stock at a specified price per share within a stated period of time. What it is you can keep the bond, but you can actually turn around and sell the warrants to somebody else if you want to. So kind of a neat little trick. It's not that common, but it is kind of a neat thing that is out there. All right. The last thing I want to talk about is where we're headed. And this is kind of, because most of this stuff in Intermediate 2 is newer stuff, and it's changing and over time. So one of the things, here we go, one of the proposals, as we're trying to work with the IASB and the FASB are trying to work together, is they're saying that maybe assets should be recorded, as we've talked about before, at fair value, with other comprehensive income, and so on. But most liabilities would be accounted for at amortized cost, the way we just discussed in this chapter, okay? And they were saying the fair value option would no longer be permitted except in unique circumstances. So even though right now there is a fair value option for liabilities, they're not encouraging for there to continue to be one in the future. However, they are cool with assets being reported at fair value. All right, so which kind of has a disconnect, because if you think about it, the assets of one business are really the liabilities of another when you're talking about investments. So, it would kind of, like I said, kind of have a disconnect. But again, I'm not the one who makes the rules. So I hope you learned something from this screencast. I hope you enjoyed this one, and hopefully we'll move on to new subjects in the next chapter. Have a great day.